3 consecutive years. That is what the S&P 500 just delivered. 3 straight years of strong returns, driven almost entirely by a handful of technology and AI names that everyone knows by now. And the natural question heading into 2026, the one serious investors are actually asking, is not whether AI keeps growing. It will. The question is, what else starts working? Because 3 years of one theme dominating everything tends to set up a rotation. Capital starts looking for the next place to earn its returns. Sectors that were overlooked while everyone piled into the same 7 or 8 names start getting attention again. And the investors who are only positioned in what worked last year are often the ones left holding the bag when the market decides it is time to reward something different. Today, I am giving you 5 ETFs that I think are specifically set up for what 2026 is actually going to reward. Not 5 versions of the same AI trade dressed up in different wrappers. 5 genuinely distinct funds. One that anchors a portfolio with quality income, one that captures the most defensive growth theme in technology, one that goes deep into AI infrastructure at every market cap level, one that plays the financial sector tailwinds building right now, and one that almost nobody is talking about that connects AI infrastructure spending to something in the ground. Each one of these funds serves a different role. Each one earns its place in the portfolio for a different reason. And by the end of this video you are going to understand exactly what that reason is. Let's get into it. Before I walk through the 5 funds individually, I want to spend a minute on the broadening market thesis because it is the context that makes the selection make sense as a portfolio rather than just a list of 5 random names. After 3 years of technology and AI driving the majority of returns, the market is entering a phase where that dominance is likely to moderate. That does not mean AI stops working. The spending is real, the revenue is real, and the infrastructure build-out has years of runway left. But when a theme has outperformed as dramatically as AI has, it becomes harder for it to keep outperforming at the same rate, simply because the valuation premium has already been priced in by a lot of investors. Meanwhile, sectors that were left behind during the AI dominance years have been quietly building earnings momentum, and the macro environment heading into 2026 is creating specific tailwinds for them. Deregulation, rate stabilization, and a recovered corporate M&A environment all favor financials. The structural demand for copper from electrification and data center build-out favors materials. Consistent cash flows and dividend growth favor quality income funds in a world where volatility is real but the economy is still growing. The 5 funds I'm about to walk you through are positioned precisely across this broadening landscape. The first ETF is VIG, the Vanguard Dividend Appreciation ETF. And I want to be upfront about something here. VIG is not a flashy pick. It is not going to double in a year. It does not have a compelling single-theme narrative that makes for an exciting YouTube thumbnail. What it has is $104 billion in assets under management, 343 holdings, a 5-year average annual return of roughly 15%, and an expense ratio of just 0.05%, the lowest on the entire list today. And those things, taken together, describe something that most investors genuinely undervalue. A quiet compounder that builds wealth reliably without demanding your constant attention. The methodology behind VIG is worth understanding because it explains why the fund behaves the way it does. VIG tracks an index of U.S. companies that have grown their dividend every year for at least 10 consecutive years. That requirement, 10 years of unbroken dividend growth, is an extremely effective filter for business quality. Companies that grow their dividend every year, without exception, through recessions and market downturns and rate cycles, are companies with strong free cash flow, clean balance sheets, and management teams that take shareholder return commitments seriously. A company with marginal cash flow, high debt, or uncertain earnings cannot sustain 10 consecutive years of dividend increases. The dividend growth requirement forces quality into the index automatically. In 2025, VIG delivered a total return of approximately 14.2%, slightly behind the broader S&P 500, which is consistent with its character. VIG tends to slightly underperform in ripping bull markets when high beta growth stocks dominate, and it tends to significantly outperform during corrections and volatile periods when investors rotate to quality. In 2022, when the S&P 500 dropped roughly 18%, VIG fell only about 9.8%. Essentially half the drawdown of the broad market. That defensive quality in falling markets is the real value proposition here, And in a year where many analysts expect increased volatility and a more mixed macro environment, that matters. The current yield is approximately 1.6%, which is modest, but the 5-year dividend growth rate is around 10% annually. An investor who bought VIG 5 years ago is now collecting roughly 2.5% yield on their original cost, and if the growth rate holds for another 5 years, that same position becomes a 4% yielder on cost. The income grows as you hold. That is the beauty of dividend growth investing, and VIG is one of the cleanest and cheapest ways to access it. The top holdings give you a sense of the quality bar: Broadcom, Microsoft, Apple, JP Morgan Chase, Eli Lilly, Visa, ExxonMobil, Johnson & Johnson, Walmart, MasterCard. These are not speculative names. They are the most established, most durable businesses in the American economy, companies that have proven through multiple market cycles that they can grow their earnings and return capital to shareholders consistently. VIG is your foundation. It is the ETF that holds the portfolio together when the other, more aggressive positions are going through turbulent periods. The second ETF is BUG, the Global X Cybersecurity ETF. Ticker BUG. And here is the argument for cybersecurity in 2026 that I think most investors are not fully appreciating. AI has made everyone more excited about technology spending. But not all technology spending is created equal when it comes to what companies can and cannot cut. Companies can decide to pause AI infrastructure investment if their earnings disappoint. They can delay cloud migrations. They can push back software upgrades. What they cannot do, not in 2026, not ever, is scale back their cybersecurity spending in a meaningful way. The threat environment does not pause because quarterly earnings missed by a penny. And the threat environment right now, in a world where AI has made it dramatically easier to write sophisticated malware and conduct coordinated attacks, is more dangerous than it has ever been. The numbers on cybersecurity spending reflect this. Global cybersecurity expenditure is projected to surpass $300 billion by 2026, growing at roughly 12% annually. A single major breach can cost a company hundreds of millions of dollars in remediation, regulatory penalties, reputational damage, and lost customer trust. The ROI on not having a major breach is essentially infinite. This is why cybersecurity budgets have remained resilient through every economic cycle, including the 2022 downturn when almost every other area of corporate technology spending got cut. When companies are laying off employees and freezing hiring, they are simultaneously maintaining or increasing their cybersecurity investment. That combination of non-discretionary spending and structurally growing threat creates one of the most durable demand curves in technology. BUG currently holds 31 companies across the cybersecurity ecosystem. A concentrated portfolio where the top 10 holdings account for approximately 55% of the fund. The names inside BUG are the real companies solving the real security problem at enterprise scale: Checkpoint Software, Fortinet, CyberArk, Palo Alto Networks, CrowdStrike, Okta, Rubrik, and others. These are not peripheral technology names. They are mission-critical infrastructure for every major corporation and government agency on the planet. The expense ratio is 0.51%, which is higher than VIG but appropriate for an actively curated sector fund with this level of specialization. Over the past 12 months, BUG is actually down slightly from its peak, which in the context of 3 years of AI dominance is not a sign of weakness, but rather a sign that the sector has been taking a breath while capital chased the flashier AI names. In the context of a broadening market where capital starts rewarding overlooked quality, that recent underperformance starts looking like an entry point. The third ETF is ARTI, the iShares Future AI and Technology ETF. And this one is where we stay within the AI theme, but approach it from a different angle than most AI ETFs. Because here is something I find genuinely interesting about ARTI's construction. Most technology ETFs are dominated by the mega caps, the Nvidias, the Microsofts, the Alphabets. These companies are important and I own several of them in various forms, but they also have valuations that already reflect significant AI optimism. The big upside in the next phase of AI is increasingly likely to come from smaller companies, the mid-caps and small caps that are building the enabling infrastructure, the software layer, the applications that run on top of the big models. ARDI specifically blends both ends of this spectrum together in a single fund, which is what makes it structurally different from a standard tech ETF. The fund holds 74 companies with the top 10 accounting for approximately 42% of the weight. That leaves 58% distributed across 64 additional holdings, including the kind of mid-cap and small-cap AI infrastructure names that most investors would never discover through individual research. The top holdings include Micron Technology, Taiwan Semiconductor, NVIDIA, AMD, Marvell Technology, Oracle, Broadcom, SK Hynix, and CoreWeave, which was one of the most anticipated technology IPOs of recent years and represents exactly the kind of dedicated AI cloud infrastructure company that embodies the next phase of the build-out. The sector breakdown is technology at 85%, with small allocations to industrials, communication services, and utilities, the latter reflecting the energy infrastructure theme that connects data center demand to power grid investment. In the past 12 months, ARDI has returned approximately 37%. That is a strong number, and the expense ratio of just under 0.50% is reasonable for a thematic ETF with active curation at this level of specificity. The case for ARDI is ultimately the case for the next phase of AI deployment, moving from foundational model training and chip infrastructure into widespread enterprise adoption, new application layers, and the physical infrastructure that makes persistent AI workloads possible at scale. If you believe that phase is real and that some of its biggest winners have not yet been widely identified by the market, which I do, then a fund that deliberately includes the smaller, less covered names, alongside the established leaders, is the most intelligent way to get that exposure without the individual stock-picking risk. The fourth ETF is XLF, the Financial Select Sector SPDR ETF. And this is the pick on this list that I am most confident about in terms of the specific 2026 timing, not because financials are always a great investment, they are highly cyclical and sensitive to macro conditions that can turn against them quickly, but because the specific combination of factors building right now in the financial sector creates what I would describe as a genuine stack of tailwinds that we have not seen lined up quite like this in several years. Let me walk through each tailwind clearly because the individual factors are each meaningful, and together they are compelling. The first is the interest rate environment. Rates have come down from their peak, and the current level creates a healthy net interest margin for banks, the spread between what they pay depositors and what they earn on loans. Not so low that margins are squeezed, not so high that loan demand collapses. A Goldilocks rate environment for bank earnings. The second is deregulation. The regulatory posture of the current administration toward financial services is materially more permissive than its predecessor. Capital requirements on large banks are being reviewed. Restrictions on certain lending activities are loosening. The compliance burden, which has been a meaningful drag on profitability for large banks since 2008, is starting to ease. The third is M&A activity. Deal-making nearly collapsed under the previous antitrust enforcement environment, particularly for major financial transactions. That environment has shifted dramatically, and investment banks, which are among XLF's largest holdings, stand to benefit directly from a resurgence in mergers, acquisitions, IPOs, and capital markets activity. Goldman Sachs, Morgan Stanley, and Citigroup all have significant investment banking revenue exposure. And the fourth is continued economic growth, loan demand, card spending, wealth management fees. All of these financial sector revenue lines grow when the economy grows. If the soft landing scenario continues to play out, financials benefit at every level. XLF itself gives you concentrated exposure to the blue-chip financial sector with 80 holdings in the top 10, Berkshire Hathaway, JP Morgan Chase, Visa, MasterCard, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, Citigroup, and American Express, accounting for approximately 56% of the fund. The expense ratio is extremely low. The 1.3% dividend yield is modest but supplemented by a 5-year dividend growth rate of around 4%. This is not a high-yield income play, it is a capital appreciation play riding specific macro tailwinds that I believe have legs throughout 2026 and into 2027. The fifth and final ETF is CowPX, the Global X Copper Miners ETF. And I want to spend real time on this one because I think it is the most underappreciated fund on this list and the one with the most potential to surprise investors who have not been paying attention to the copper story. Here is the thesis in its most direct form. AI is an electricity story. Building and running AI at scale requires enormous amounts of power, enormous amounts that are growing. Every data center that gets built consumes electricity. Every electric vehicle that gets sold runs on electricity. Every solar farm and wind installation that gets connected to the grid requires copper cable to move that electricity from where it is generated to where it is used. Copper is the conductor of the modern economy. It sits inside every wire, every motor, every transformer, every data center cable run. You cannot electrify anything, not a car, not a factory, not a data center, not a grid upgrade, without copper, and the global supply of copper is not keeping pace with this demand. S&P Global published an analysis projecting that copper demand is likely to increase by 50% by 2040, half again as much copper as the world currently uses, required in just 15 years. The problem is that new copper mines take a decade or more to develop from discovery to production. The pipeline of new supply is deeply insufficient to meet projected demand. That structural imbalance, rising demand meeting constrained supply, is one of the most compelling commodity setups of the decade. Copper is trading at multi-year highs, and COPX, which gives you diversified exposure to the miners extracting that copper, has reflected this through extraordinary performance. Over the past 12 months, COPX has delivered a total return of approximately 134%. Yes, you read that correctly. The fund currently has approximately $5 billion in assets under management, holds 46 companies including Freeport-McMoRan, Southern Copper, First Quantum Minerals, and a range of global copper miners, and carries an expense ratio of 0.65%. You also get a dividend yield of approximately 2.5% paid semi-annually, with a strong 5-year dividend growth rate that reflects the improving cash flows of copper mining companies as the commodity price has risen. That 134% 12-month return is exceptional and almost certainly not repeatable in the next 12 months at the same rate. I want to be completely clear about that, but the structural demand thesis does not go away when the near-term price momentum moderates. This is a multi-year story driven by forces: AI infrastructure build-out, EV adoption, grid modernization, energy transition, that are not reversing. Copper is not precious like gold in the psychological sense, it is precious in the economic sense. It is an essential input to the most important technology and infrastructure transitions of our era, and COPX is the most direct, diversified, cost-effective way to invest in the companies that extract it. I do want to name the risks here clearly, because ignoring them would be irresponsible. COPX is sensitive to Chinese economic data since China consumes roughly half the world's copper. A significant slowdown in Chinese manufacturing or construction activity depresses copper prices directly. The fund is also volatile. Mining stocks amplify commodity price movements in both directions. And the tariff environment, with recent discussions about U.S. copper import duties, creates near-term uncertainty, even though the long-term structural demand thesis is entirely intact. COPX belongs in a portfolio as a tactical materials position, not as a core holding. Size it according to your conviction and your risk tolerance. Let me tie all 5 together and show how they function as a coordinated portfolio structure rather than 5 disconnected bets. VG is your foundation, the quality income compounder that reduces volatility, pays growing dividends, and holds up better than the market in downturns. It is the thing you hold the rest of the portfolio against. BUG is your defensive growth position, cybersecurity exposure that benefits from a structural demand trend that is immune to economic cycles. Even if corporate earnings disappoint across the board in 2026, security budgets do not get cut. ARTI is your offensive AI growth position, the fund that blends large-cap AI infrastructure leadership with the mid-cap and small-cap AI enablers that most investors are not yet paying attention to. XLF is your macro rotation trade, financial sector exposure specifically positioned for the deregulation, M&A revival, and rate environment that 2026 is setting up. And COPX is your materials wildcard, the unexpected connection between AI infrastructure spending and a physical commodity in structural deficit that has been quietly delivering extraordinary returns while everyone was focused on software. Together, these 5 funds give you income, defensive growth, aggressive growth, cyclical macro exposure, and commodity infrastructure all in a single portfolio. No two of them are doing the same job, no two of them will move identically in response to market events, and that diversity of function is exactly what makes this a portfolio, rather than just a collection of ETFs. The best outcome is that VIG holds firm, Bug keeps compounding steadily, ARDI catches the next leg of AI deployment, XLF benefits from financial sector tailwinds, and COPX continues riding the copper demand story. The realistic outcome is that 3 or 4 of these work well and 1 disappoints, which is a perfectly good result when each position was sized and selected with clear reasoning rather than hope. I want to close with the single most important piece of context for any ETF investing decision in 2026. We are coming off 3 exceptional years in the market. The base effect of those returns means expectations should be more measured going forward. Not because the economy is in trouble, but because compounding exceptional returns gets mathematically harder the higher you go. The investors who are going to do best this year are not the ones who found the hottest ticker on social media. They are the ones who had a clear thesis for each position they held, diversified across multiple themes rather than concentrating in one, and stayed invested through the inevitable volatility rather than reacting to headlines. These 5 funds are built for that kind of disciplined, thesis-driven approach. I hope they give you something genuinely useful to work with. If you found this video helpful, hit the like button and subscribe. I put out new content regularly on individual stocks, ETFs, and portfolio construction strategy, and drop a comment below telling me which of these 5 funds you are most interested in and why. I genuinely read every one. I will see you in the next video.